Well, hello everyone, and welcome to today's webinar, Keeping the Lights On with AI, Stabilising Energy Markets via Flexible Assets and Automated Trading. My name is Ben Hillary. I'm the Managing Director of Commodities People, and really would like to say a huge thank you to you all for being here with us today. Really delighted to see just how much this webinar has attracted the interest of the global energy trading community, with 1,100 registrants from all corners of the globe. In the next 90 minutes, we're going to be exploring what's actually been going wrong in global energy markets. Is the current market design no longer fit for purpose in the era of the energy transition? Can the twin forces of AI and flexibility markets bring much needed stability to the grid? And finally, how you, with your flexibility, can not only be an active participant in the energy transition, but can also generate additional income streams by marketing it on power spot markets in a surprisingly easy and straightforward manner. I'm absolutely delighted and thrilled to be joined here today by some of the most innovative minds in this field today. Jürgen Meyerhofer, CEO and co-founder of Inspired, Alex Schoch, Head of Flexibility Octopus Energy, Katarina Nisizhevska, Key Account Manager at EPEX-Spot, Matt Bednarczyk, Hydrogen Energy Systems Engineer at Green Planet Energy, Kim Kanitz, Energy Systems and Technological Development, also at Green Planet Energy, and finally, Błażej Radomski, Principal Specialist, Europe and Japan Power Markets, Wood Mackenzie. Today's webinar will start with a series of short presentations, followed by a panel discussion and a Q&A. So on that note, throughout the webinar, please be posting your questions in the Q&A box, and also please upvote others of interest. Also, do make full use of the chat channel for any comments you wish to share with the panel and the audience, or even just to introduce yourself. I am now delighted to pass over to Jürgen Meyerhofer, CEO and co-founder of Inspired. Jürgen, the floor is yours.
Thanks, Ben. Hello, everyone. I'm Jürgen. I guess most of you are super busy as we're living in weird times, both when it comes to the pandemic and when it comes to the energy crisis, especially in Europe. So I want to thank you for taking the time to spend the next 90 minutes with us. A big thank you also to the speakers. That's an excellent lineup, and actually it was much easier to convince them that I thought. I think it took us like 2 days to get it done. For the people who don't know us, so Inspired yet, I will give a brief introduction about what we do so that you get some context and idea why we have chosen today's topic and why it's relevant, and even more important, why we as Inspired are passionate about it. So we at Inspired, we have founded the company nearly exactly 2 years ago, so on the 31st of January 2020, with the overall goal of helping or boosting the energy transition. And what we have seen in the last 5 to 6 years is a rapid development on spot markets, especially intraday markets across Europe. So Katarina will tell us something about that. So we set out to build a fully digital trading company. So that comes with a big background in marketing, because people like to see trading floors with 12 screens and all that stuff. So actually our office is quite boring, because we have mainly software developers or traders that develop software. So everything is automated end to end, no human interventions, unless building models at the moment. We have a heavy bet on artificial intelligence, so not for purposes to sound fancy. We have a separate team. We have deep tech grants that really work on reinforcement learning. So I'll give you an idea on later on what we're working on. Heavy focus on data, and recently funded in our Series A to expand our service that we have across Europe over the next 2 years, with having an eye on global markets. So our goal with having all the technology data in mind and in our backpack, we set out to help every asset owner big or small, pump storage, thermal generation, batteries, to offer flexibility on the short-term markets. Thanks, Ben. Back to you.
Excellent. Many thanks for that, Jürgen. Well, Alex, over to you.
Thank you. It's a pleasure to be here, and thank you, Jürgen, for the invite. So I think for those of you that that may have not heard of Octopus Energy, or maybe have heard of it in certain contexts, I think it's useful in the framework of this webinar to kind of mention why is Octopus Energy here. So we are an energy technology company that is also an energy retailer, and since last summer also the owner and operator of 3 gigawatts of renewable assets across Europe. So as we kind of look at stitching together and digitizing the end-to-end energy value chain, we fundamentally have to rely on technology, and with that comes a high degree of automation. And if we look at the current situation that the market is in, and us as an energy retailer with 3 million customer accounts in the UK alone, being able to have a surety of how we tie together shaping consumer demand, the volatility and intermittency of renewable generations, and an even more volatile wholesale power market becomes more and more valuable. And so as we look at the greater growth of renewable generation as a percentage share in every deregulated market, as we look at the growth of storage and other technologies to kind of bridge the gap as baseload reduces, we see a fundamental need to make sure that it's not just the end customer experience that is digitized and made seamless and made transparent, but also the operation of renewable generation plants. We're gone are the days of just as produced power. It's about managing power. It's about tying together highly accurate forecasts, not just of production, but also of demand. And tying that all together has to be done in a seamless and automated and fully digital way. We cannot have control rooms where there are still humans that need to press a button to dispatch an asset. You can't call on the red phone anymore to get a coal power station spun up or get it operating at 110%. So I'm really excited for this discussion, and thank you very much.
Excellent. Many thanks, Alex. Well, Katrina, the stage is yours.
Thank you very much. And also from my side, good afternoon, everybody. And many thanks to Jürgen and to Inspired for having invited me to this very interesting webinar. So my name is Katarina Ichijewska. I'm Key Account Manager at IPEXpot, and I'm going to present you in the few next minutes some trends that we observe as a spot exchange as IPEXpot on the markets, on the intraday markets currently. So let me just try to share my screen. I hope that you can see the screen now. So please just confirm whether you can see the screen actually. I hope so. No reply means you see the screen. So let's have first a look at the IPEXpot markets, at the volumes which were traded last year on the IPEXpot market. So you see on the right-hand side a map with all spot markets which you can trade via IPEXpot. So including obviously all CWE markets, but also GB, all the 4 Nordic markets, and since last year as well, Poland. And you can see also in dark gray, those markets where we as IPEXpot are service provider for other exchanges. And overall, 621 terawatt hours were traded in 2021 on all IPEXpot markets. And this is a growth of almost 1% in comparison to 2020. And the highest increase in volumes we have actually seen on the intraday markets, where 123 terawatt hours were traded in 2021. And that's a growth of 10% in comparison to 2020. And you can see from the table below that this massive growth in intraday volumes, it's not only for the first time in 2021, but it's there for several years already. Now, having these growth and these volumes of the intraday markets in mind, from the slide before, let's have a look at the growth of the API applications used on the Apex intraday markets. So today, around 279 Apex members, which represents around 85% of all Apex members, use API applications. And in total, 326 API applications are connected to the M7 system today. Out of these 329 connections, around 40% are pure read-only applications, so applications which are following the market and positions, and around 60% of all M7 APIs APIs for automatic trading strategies. On the chart below, you can see the growth of the APIs since July 2012, when the first M7 API went live in production. And you can also see major M7 releases launched over the past year and major changes on the intraday markets, like the go live of the XBIT project in June 2018, for instance, or also the switch of trading system from Eurolight to M7 in GB in November 2018. And you can, by the way, see as well from the different colors that the majority of all API applications are member applications, but there are also a few basically data vendor applications in gray here on the slide. So now we have seen the growth of intraday volumes, the growth of usage of API applications, but what does this actually mean for manual trading and for the well, predefined front end of M7, which is called ComTrader? So you can see on this slide that circa or around 80% of the trades have at least one leg submitted via an API. That's an increase of 19% in comparison to 2020. And you can see this growth of this trend on the left-hand side, in the graph on the left-hand side. When looking at the volumes, we have seen in 2021 for the first time ever that the traded volumes via API applications were higher than the manual traded volumes via ComTrader. And you see basically then that in 2018, only 1/3 of all volumes was traded via an API. And in only 4 years, basically, the setup changed completely, and now 55% of volumes are traded via an API. And maybe in this context, also something that might be interesting for some of you, is that around 60% of all connected APIs are APIs developed by ESVs, while circa 40% are in-house development, so API applications developed by our members. And you can, by the way, find also the full list of certified independent software vendors on our website. You can see the link on the slide. So now maybe one last observation I would like to share with you is the figures of submitted orders, which has also massively increased. So we see today on average a number of 2.8 million orders being submitted to the intraday trading system M7 on a daily basis. And around 97% of these orders come from API applications today. So again, a massive number. So to sum up, we have seen that the volumes traded on the Apex intraday markets have increased massively over the past years, with 123 terawatt hours traded last year on the Apex intraday markets. We have seen as well that we observe a continuous growth of APIs connected to the trading system. And we have seen for the first time in 2021, so last year, that most traded volumes on the continuous intraday markets at ePexport were traded via API applications. And finally, we have also seen that the number of submitted orders has massively increased in the past years. So that were the trends I would like to share with you. And of course, please don't hesitate to contact us if you have any questions. And yeah, with this, I will stop the sharing of my screen. Thank you very much.
That's lovely. Many thanks for that, Katharina. Matsenkin, the floor is yours.
Perfect. I'll start with our presentation titled Physical and Economic Integration of Fluctuation with Decentralized Electrolyzers. We are actually representing the demand side because we are on the demand side demanding the electricity, the surplus electricity with a flexible asset. We, that is me, Mats Bednarczyk, and Kim Karnitz, my colleague, we're both project engineers at Green Planet Energy. And as project engineers, we develop projects that have the goal to integrate fluctuation with flexible assets. So just a quick summary about us, Green Planet Energy. We are an energy supplier from Germany, founded by Greenpeace back in 2000, and we are committed to the energy transition. We have almost 180,000 electricity customers, more than 30,000 gas customers. We also have almost 30,000 cooperative members because we as a company are structured as a cooperative. That means that anyone can participate in our company with a minor share of 55 euros. You can become an owner of our company and participate in the energy transition. We have more than 200 employees since this year. We operate and build 16 wind farms, 4 PV power plants, and 2 electrolyzers. I'm going to tell you about a long word, which is energy transition serving. And that is our main criteria when we assess projects and when we decide whether to do a project or not, or whether something has to be tweaked to make it an energy transition serving project, because energy transition serving action improves the physical and market integration of fluctuation into an efficient energy system, and it also supports the development of the system based on 100% renewables. This means regarding electrolyzers, we have special operation modes, which also are concluded in a special electrolyzer control operation mode. So we only want to operate our electrolyzers when there's a surplus of renewable energy, because there's still a lack in renewable energy in the electricity grid. Renewable energy is best situated in the electricity grid, and if there's a surplus situation, then the surplus can be used to produce hydrogen. So the most straightforward approach is the mitigation of curtailment using electrolyzers. We also use PPAs to link the electrolyzer to renewable production. Then we structure the feed-in power of renewable assets to optimize balancing groups, and we also offer system services. Now that I talked about the production of hydrogen, we also want to give you a quick recap of the future role of hydrogen. So we actually have this gas product because we have the gas customers I told you about, and it is used that it functions that we use surplus wind energy to power the electrolyzer and then produce hydrogen. Then we mix the hydrogen with biogas and natural gas to feed the demand of our customers. But in the future, hydrogen will also be used in the industry sector and the mobility sector. And we also want to use the co-products of excess heat and oxygen. Oxygen can, for example, be used in sewage plant or in the paper industry, and excess heat can be used for heat supply of urban districts. Now we have a look at our hydrogen suppliers. So we have 2 plants on our own with some very German sounding city names here. So one is Windgas Haurup, the other one is Windgas Haßfurt. And then we have also our suppliers, which is Brunsbüttel, Hybrid Power Plant Prenzlau, and the Energy Park Mainz. And now I'll give the word to my colleague, Kim.
Thank you very much. I would like to present to you our new electrolyzer project, Windgas Haurup, which we have installed with our partners Energie des Nordens. The electrolyzer is located in Haurup, which is in the north of Germany near the Danish border. And here we installed an electrolyzer with a size of 1 megawatt, which have been taken into operation September last year. It's the first 1 megawatt electrolyzer from Hartec System. The electrolyzer is connected to the electricity grid, and our operation mode is based on the local wind situation. The hydrogen here is used for sector coupling. The produced hydrogen is fed into the local gas grid and can be fed in up to 2% by volume, can be fed into the local gas grid. In summer, this feed-in limitations can limit the operation mode of this electrolyzer, so we cannot always run up to full load in summertime. The hydrogen feed-in is integrated in our gas tariff, as Mats showed you before, and made available to our heating consumers. In Haurup, the electrolyzer reaches about 4,000 to 4,500 full load hours a year. So we can produce about 3,000 megawatt hours of hydrogen. And if we replace natural gas with this green hydrogen based on renewable energies, we save about 500 tons CO2 a year. As Mats told before, the electrolyzers should represent a flexibility option for the power grid. So the graph on the left shows, we call it network traffic lights of North Germany, and the red market regions, these are regions with high curtailments of wind turbines. Due to the network expansion, the curtailments have decreased in the last years, but still in the region around Haurup and also in the North Germany, the wind turbines were curtailed up to 50% of the operation time in 2020. So our first goal is to use the electrolyzer to reduce the curtailments of wind energy in this region. Therefore, we offer our electrolyzer as a flexibility platform of the local grid operator. At the moment, there's no financial advantage for this because the political regulations do not allow it. But we can use the electrolyzers to reduce the curtailments. The second operation mode we are presenting, or we are doing in Haurup, is that we use the electrolyzer to support the integration of wind energy into our wind portfolio. This is needed because we already have an electricity mix with over 50% wind power, so we need a lot of structuring for our wind portfolio. And the third operation mode we are doing here, we want to show, is system services. And the aim is to show that also power to gas systems in combination with renewable energies can do system services, and we do not longer require conventional power plants for these requirements. On the next slide, you see a combination of two of these operation modes. So we are offering primary control reserve. You can see that the electrolyzer is responding to local frequency disturbances. And at the same time, we get a signal from the grid operator that there is containment in the region, and we increase the load of the electrolyzers. So that's how electrolyzers can be used as a flexibility option to stabilize the grid. To sum it up, we would like to emphasize that there's still a shortage of renewable energies, and we should use electricity as best we can. Electrolyzers should present flexibility option for the power grid and should promote the integration of the fluctuant renewables into the power grid, and at the same time promote the sector coupling. The operation concept of the electrolyzer is crucial for the climate benefits, and so we should focus on only renewable hydrogen based on fluctuating renewable energies. We need new markets and incentives to establish electrolyzers as flexible options because there are no markets at the moment, for example, to reduce curtailments. And decentralized electrolyzers are especially efficient in responding to local grid behavior. Thank you very much.
Excellent. Many thanks for that, Kim and Mats. Well, now, Błażej, over to you.
Thank you, Ben. My name is Błażej Radomski, and I am representing WoodMag. I will start with sharing my screen. Hopefully you can see it now. So jumping directly into my agenda as the time is flying. just wanted to cover the topic of algo trading with some data feed with you. So where to place algo trading? Obviously, within a data intense trading regions. So from my point of view, algo traders are operating the most successfully in, for example, continuously traded intraday. So to share with you some views on the volumes traded, don't want to repeat what Katarina from Apex said already on, in general, growing volumes. I instead share with you this division into hourly contracts and 15 minutes contracts. So I cover in these slides monthly traded volumes in the last 2 years, heavily affected by lockdowns and pandemic problems. So we obviously see that the share of contracts with lower granularity, in this example 15 minutes contracts, is growing faster than more stable volumes in still basic hourly contracts. But this was said already, as I mentioned. What is really interesting in this volumes view in terms of algo trading usage is maybe a changing pattern of traded volumes. Here on these 3 heat maps, I'm showing you volumes for 24 hourly products. So on the y-axis, we have 24 tradable hours. In autumn 2019 on the left, 2020 in the mid, and in September 2021 to the right. And on the x-axis, we have a timeline. So we have minutes until delivery, and the slots are of 15 minutes size. So what we see on these heat maps, we see first of all a lot of red and orange fields to the very right side of each chart. What means that the majority of transactions can be recorded close to delivery, or better to say, close to gate closure. On top, we see that in 2021, the opening of the market, so these stairs, is very systematic. So the first transactions can be always observed after the opening of the market at 3 p.m. the day before already, while in 2019 it was not the case. And maybe the most interesting observation is related to these diagonal white patterns in each heat map. And these white patterns, they mean increased volumes in these 15-minute slots. And these increased volumes can be observed for very specific time points, which do represent eventually the opening of exit phase, right? But they do represent also a publication of an important forecast. So taking a look at one example, this is our 0203 in January 2021. The same logic. On the x-axis, we have minutes until delivery, and we observe the density function being very close, or the maximum being very close to the gate closure moment. But what's really fascinating is actually the zigzag pattern, showing that there is, for some reason, there is more activity at full hours and half past a full hour, and not 15 minutes before or 15 minutes after. This is very interesting. On top, what I find also very interesting are these local maxima, which do represent more activity at specific times prior to delivery. So they represent, as I said, these crucial moments: exit start, important information released, and so on and so forth. So now, from the algo trader perspective, it would be extremely important to be able to hit this market phase, which has higher volumes. Why? Because higher volumes mean better liquidity. So how to feed the algo traders? This is the crucial question, right? In order to be active in this specific moment of times. So the beginning is, of course, the first step is, of course, the forecast, right? It must be precise, of high quality, frequently updated, delivered in the right format, and so on and so forth. So if we take an example of wind forecasts and solar forecasts, so typical renewables forecast for Germany in the current month, we see, okay, the first view tells us the wind generation is contributing in a much higher matter than the solar generation, not surprisingly, right? January is not that sunny month. But this is not the entire story. The other question is if we can expect even more wind maybe in these maximum hours. So for this, we need a look at the capacity utilization. And here we see that the interesting hours in the second half of January, we had the wind capacity utilization up to 75, 78%, while solar utilization was reaching maybe 20% for single hours, right? So this is the first information for the algo trader, to which extent is the current weather situation allowing the technology to be not fully, but to which extent it allows the technology to be utilized. And then no model is perfect, right? So how to track the error? In order to track the error, and still we are thinking about really fast tracking in order to be active in the right phase of the market, we can collect the generation data. So in this example, we have 2 wind farms, offshore wind farms in Germany. And what we see from these 2 pictures, we see that the one on the right-hand side is bigger than the one on the left-hand side, or at least it's contributing to a higher degree to the total wind generation in Germany. If we plot the installed capacity, we see indeed the right one is bigger. But again, we see that the maximum generation is not during the same hours, not during the same days. And on top, the maximum utilization is deviating very strongly. So potentially the smaller farm on the left-hand side has more potential if we should observe higher wind speeds. The one of the right-hand side is utilizing its capacity already to 47% in average. So this is the information which can, if collected in real time, can be extrapolated for the whole price zone or whole country, and can let us know if we are dealing with forecast errors or not. WoodMac is able to collect this information via a fleet of monitors distributed all around the world. In Europe, of the highest importance are the electromagnetic field sensors, EMF sensors, which can monitor and really estimate the generation in megawatt hour produced. Second type are infrared or photo cameras, which are more working like on and off and able to spot if the power plant is producing or not. So with this fleet, and coming back to the to our example, we need 2 components: a good wind forecast, right? But on top, we need also real-time wind generation data in order to estimate the forecast error, because the forecast error is implying the volume which will enter the intraday market. And if we have the estimate for this volume, we can derive signals for bullish or bearish signals. Beyond these, all other types of data is, of course, essential or can be essential: generation, transmission, outage, curtailment, right, as Mats and Kim mentioned just before, cross-border flows. So basically everything, and in different time horizons, of course. So like forecast, real time, and historical data. I guess that's what we can provide, what we can prove as a good feed for AI algorithms, and as a good idea of running algo trading in these continuously traded intraday markets. So now I'm at the end. Thank you for your attention, and I'm looking forward to answer your questions. And now we will be jumping into the panel discussion, Sean.
Many,
So,
many,
thank you.
many thanks, Roger. That's really, really fascinating data. Well, just before the panel, we'll hand over to Jürgen, please.
Thanks, Ben. So I will talking about a topic that nicely integrates with whatever you have heard over the last speaker slots. So I'll be talking about how to optimize a trading strategy for flexible assets. So now imagine you heard from Kim and Mats that you could offer flexibility by increasing or decreasing demand of an electrolyzer to the intraday market, which has some benefits like being very flexible. You don't have to commit the flexibility to a TSO, so you can change your mind basically every millisecond in trading ways. And I want to give you an idea of what it means if we say we trade flexibility, right? You cannot say I have a car. There is different types of cars, and this is one possible approach how to do that. So firstly, what we've observed over the last years is that this is kind of 2015 stuff, right? That people wanted to automate repetitive tasks. So the goal was efficiency. The example would be instead of just placing just-in-case orders as a trader, you want to have that automated. And back then we were asked in the previous company, can you automated order placements within seconds? So that was the requirements like 5 years ago. Once you did that, the next thing is, okay, what is the right spread for buying back a position, right? This means you already sold your flexibility and you would buy it back if it's not any longer needed by the market. And that could be 3 euros, 8 euros, 20 or 30 or 80 euros. So the next step we have seen, and what a lot of people also do, is try to estimate what would be a good spread, right? And that's why we called it good spread, because first of all, usually it's probabilistic. You could also do it with brute force. The shortcoming of that optimization step still is that you look at the optimal spread, for example, based on historic data from the last year. So your flexibility trading strategy will behave the same in summer, in winter, during day, night, peak, off peak, whatever, right? So what you ideally want to do, and then it's getting more tricky and into the area of what Blažej was already teasering, is you want to have trading strategies that kind of say, today is a high wind level, like 35 gigawatts in Germany. I want to behave different, right, as a trading strategy, because you observe in the market that it's rather trending when wind is super high or is super low. You want to behave differently. You also have seen that before, 4 hours before delivery compared to 30 minutes before delivery. So you want to have this whole trading strategy more adaptable. So the next idea is, of course, say make the spread dependent on external data. Could be wind forecast, residual loads, prices in other markets, available cross-border capacities. So the complexity from the first two steps makes a huge jump, right? So I will show you an example afterwards. And this is the first time where fundamental data comes into play. So you can do the first two steps just with order book data. So that's the data that you get as an EPEX or exchange member. That's data you get via read-only access. So you have one data source combined to multiple data sources. When you get that done and say your trading strategy is adapting to different wind or fundamental situations or actually what's happening on the market, the next step is kind of you realize that everything or all your decisions are purely based on historical data, right? And you would say, okay, but actually I'm interested in what's coming in the future. Is there a tendency prices go up or down? And you want to integrate it, right? So as a trading strategy would not only say, I behave like this in the current market environment, but if a price forecast says there is a 63% likelihood that the prices go up and you need to sell, you would most certainly wait. So you're adding another dimension of decision criteria, and you, of course, can have multiple of these market signals. This is the point in time where brute force and most of the probabilistic methodologies, if you don't consider machine learning now in that class, have serious shortcomings when it comes to runtime, etc. So you don't want to wait for weeks just to find out that your model is not working. And the final step, and this is what we're also working on, also to be fair and honest, this is not in the market yet. This is a reinforcement learning setup where you basically, exaggerate now, you throw all the data, all the signals into a model, and the model decides, in this market situation, I adjust the spread to that, the aggressiveness, how I behave in the market is something different. I leverage this price forecast, but I ignore the volatility expectation because that's not interesting for me or whatever. So this is then a real setup where we just outperform humans in any way, right? Until now, and that's why we call it augmented trading. There is always human ideas. There's always humans checking up if the models are doing the right thing. And the final step would be really to just create new knowledge that you cannot see on a trading screen. And of course, last but not least, this is not true just for one product. We're talking flexible assets, so we have to consider charging cycles, efficiency losses, ramps, minimum run times on load points, different marginal prices on different load levels. And of course, your trading strategy needs to leverage all market phases. I mean, you have to actively decide, do I bid in the auction? How do I bid into an auction? What volumes do I leave open for intraday? Do I do that different every day for every product? Or if you have storage, you also have to consider time arbitrage, right? So it's not within one product or 1 hour, quarter hour. It's you buy in the morning and you sell in the evening. So that's a complexity where you certainly have all hands full and need more than 12 screens if you want to trade it as a human. When it comes to what does it bring in terms of money, we have one example here, which is it's a small pump storage example. This data is validated in real life trading, recreated with backtesting with a ±5% accuracy. The first line is just the intraday auction. So the 15-minute auction at 3 p.m. So hourly products actually don't make too much sense for a pump storage because the spreads are not big enough. The next line is pure continuous intraday. And yes, these are 3 months that have been highly volatile. So the pure intraday value is dependent on volatility in that market. Plus 90% on average over all 3 months is, I think, quite an improvement, just to get a sense what we're talking here in terms of improvement. Then we had one version of our strategy that decides how much to place into the auction, how much to leave open for continuous intraday trading, plus a storage optimization that runs in real time and delivers the perfect utilization based on current market circumstances, another 22% on average. And the last step is, or was in this example, to also include market expectation. That's something highly relevant for pump storages in that case, because you maybe want to look at tomorrow, right? If tomorrow the price level is 100 euros higher, you want to pump the whole day, even you could capture spreads within the day, or you want to look at the weekend. On average, 150% compared to just finish your job day ahead at 3 p.m. Just think about it. Just more than doubled the revenue, and this is not the end, right? And there is a lot of untapped potential we're working on day by day. There is other market expectations, better volatility forecasts. There is additional adaptive behavior. You can leverage more than 3, 5, 10 parameters, right? And find out what's the best combination in which market situation. And then finally, I talked about reinforcement learning. We expect that to be a real game changer in the next 2 years. Finally, and then I'm done, just a glimpse on how that looks like. I try to make it really short and easy. So what we do is we do regular backtests for certain scenarios. This is a parameter optimization scenario, just to get a feeling what energy trading companies are doing. So in the left column, you have the raw data. This is a thermal flexibility trading strategy, all the backtest, and this is the results in terms of euros per product. So actually it's a cloud. You don't see anything. The next 3 columns are just statistical measures to have a look at it. So it's, for example, the mean. One axis is one parameter, the other parameter, and going up is the euros, the amount of P&L you generate with that asset. And the right two columns is a neural network that's trained to predict that planes. And what you can use, and that's, for example, on the right-hand side, the case, you can use a reinforcement learning agent. So that's the red one, to find the local optimum. On this would say you, in this case, we have chosen, I think, wind levels about 30 gigawatts. So high renewable penetration scenarios. You would say if the wind is higher than 30 gigawatts in Germany for that one product, I would set these two parameters in that way, the dynamic parameters, to get the maximum profitability of my position. Now imagine, and then I'm over. Now imagine you're not talking about two parameters. We've chosen that because you can visualize it. Think about 10 parameters and 4 forecasts, the price forecast, the volatility forecast, whatever. So that's not going to work out in your mind, no matter how many screens you have. So this is the stuff companies work on or should work on if they really want to create an incentive to bring flexible assets to the market, because unfortunately the return of the asset is a very good incentive and very convincing. Thank you. Ben, I forgot something before I say thank you. Actually, our plan for the next webinar is what I just shed a first light on, is to go into more detail for one specific asset type. So thanks, Ben. So our question would be to you as an audience: what is the preferred asset type that we should initially cover in our next meeting, our next webinar? So where should we go into more detail, show more P&L, get into more detail on what parameters are available, what data is necessary to really get the most out of your asset? So now, thank you.
Excellent. Many thanks, Jürgen, and many thanks to all of our speakers for their fascinating insights there. Well, it looks quite a strong reaction in favour of battery storage on the poll there. So that is interesting. Right, now, building on all of those points raised, I've got a few questions for the panelists. Audience, please do continue to ask your questions via the Q&A box. Please be upvoting those, and we'll be answering them towards the end of the panel discussion. Firstly, I'd like to direct this question to Alex, then followed by Katharina. What role do the short-term power markets play when it comes to the current energy crisis?
Great question, Ben. Look, I think if we look at the kind of wholesale power markets across Europe, and especially the UK, where those of you that follow, pretty shocking prices that were hit, both on intraday, but also balancing mechanism prices. Fundamentally, if we think about like the finalization of supply and demand on a wholesale power market that is looking to actively have a large pool of buyers who are looking to not only satiate their own energy demands, but also ensure that more and more of their energy is 100% certified renewable through certificates. We have a compounding factor here of gas shortages and gas supply shortages, both from Russia, but also other delivery locations, and historically some very shockingly poor wind generation weeks. Those short-term squeezes are going to have an annualized impact on the energy on energy procurement and therefore energy delivery. For any retailer in the market, we've seen how precarious that position can be for participants who are not adequately hedged or did not actually have a sophisticated, or shall we say even comprehensive, hedging strategy in place. And so then, if we think about how that then has a knock-on effect, we're definitely not seeing a near-term end to this current long-term spike in wholesale markets. It's, I think, in many ways, I would say, we've shifted slightly from a significant winter peak and winter price excesses to just a significantly higher baseline for power sales, where short-term optimization is going to become a very critical part to squeezing out, just some returns, not even significant returns. Now, of course, if you had what happened yesterday on the intraday spread in the UK, then it would have been significant profits, and some power traders are probably very happy right now for those that called it.
Excellent, many thanks. Katharina, your thoughts on that?
Yes, thank you very much for giving me the opportunity to share my thoughts on this. So I think the short-term markets play really a key role, because at the end, what is happening on the short-term markets, they are basically organizing the dispatch of resources which are needed to meet the load at least costs. And the short-term markets also send a signal about the value of electricity to the market. And this signal reflects basically all fundamental drivers, as Alex mentioned as well. So all important figures which came into account when we're talking about price formation, such as fuel costs, CO2 costs, availabilities of assets, demand, weather, and so on. And currently, as Alex clearly stated, currently the main driver of the high prices are gas prices and the prices for gas power plants, or for the run of gas power plants, and the cost of CO2. And I think that technologies which can run at lower costs, they contribute together with future power prices expectations, basically to drive investments into new resources. So this can be, of course, renewable resources, but also nuclear resources, for instance. And this price signal, which is coming from the spot market, is super important for the energy transition, because the energy transition requires massive new investments into renewable assets, into flexible assets, but also into a grid infrastructure. So therefore, I think it's really key.
Excellent. Well, following on from that then, I'd like to address the next question to Mats, followed by Katharina again. How can flexible assets help on our way to transition to clean energy? Oh, sorry, Mats, you're on the mute there.
We can't hear you.
Sorry. No, you can. Katharina just mentioned the investment that come with energy transition. Energy transition comes with a cost, an investment, but also with an adaptation, a shift in the energy systems, and it also has to always be mentioned that it comes with a huge benefit. Never always keep in mind the benefit that comes with the energy transition, but it also is a challenge. The energy system was built in a way that we can adapt production towards demand. And now there's a shift where we have to adapt to the fluctuating generation of renewables, especially wind and solar. And you can adapt the consumption as well to an extent via demand-side management. So you can set an incentive and market signal like dynamic pricing, which is also asked in the questions. But some demand also just cannot be taken down, just not flexible. So you have to adapt, and flexible assets like electrolyzers, like batteries, electric vehicle charging, and maybe also bidirectional charging can be used. Heat pumps can be used combined with heating inertia to match the production and consumption, and there's a huge value in it. Jürgen just showed you how much value there is in it, but it is also a demand for optimization. So we ourselves are actually right now building an electrolyzer operation mode that optimizes based on the operation modes we just presented. And the flexibility options just help match production and demand, and that's the main task of them.
Excellent. Katharina, your thoughts on that?
Yes, I think if we all assume and agree that the amounts of renewable capacity is going to increase significantly in the next years or in the coming years, I think that we will need more and more resources or assets which will help or which need to help basically to balance demand and supply, because generation ramps are likely to become very steep. And also assets and renewables to solve the congestion of both the high voltage grids and the low voltage grids. And I think this effect or this need for this kind of flexible assets will even increase with the closure or the significant closure of conventional capacities, which are planned, for instance, in Germany. So I think there's a huge need for flexibilities, to sum up, basically.
Absolutely. Next question I'll direct to Alex, followed by Jürgen. How crucial is storage to increase the share of renewables?
Thanks, Ben. So I think there isn't really a future of a even 90% renewable generation mix without storage at a system level. And that's fundamentally like, the obvious intermittency element of renewable generation, but also the additional services that storage can provide at a local level and at a system level are already proven. So if we look at the UK as an example, or if we look at Australia, we have large batteries that are already providing kind of crucial fast reaction stabilization services, but are also able to quickly switch into either arbitrage mode to take advantage or balancing actions. And I think that becomes even more critical. I mean, if we look at in 2021 alone, UK balancing costs rose by 48%. And that's only going one way. So like the need for storage is critical, but the just storage on its own is kind of pointless. Like when the first large batteries were installed and commissioned in Australia, one of the first larger ones, I shan't name names to not put any company on the spot, but there was a certain trader who was absolutely convinced that he could manually best dispatch that asset. And if you then looked at, similar to what Balázs was showing, a heat map of the actual dispatchability, probably missed about 95% of all opportunities to dispatch the battery in the right market at the right time. So that's where the learned behavior and then over time further improved dispatching strategies and the timeliness of the right signals, ingesting those and making the right decisions is something that is crucial to enable storage to play the part that it can play in smoothing out short-term gaps.
Absolutely. Jürgen, your views?
I totally agree with what Alex said. I want to add that there is different types, of course, of storage. I mean, what Alex referred to was big battery systems. Rather, we're also confronted. We have a lot of talks regarding mid-sized and also smaller batteries. So having in mind that we will need them to accomplish the energy transition, the regulations around it really makes me worried. So you guys live in Wonderland in UK when it comes to flexibility options, rights and markets and the regulation around that. In Germany or other continental European markets try to get a hand on a behind the meter battery and market it on Katharina's intraday market, right? That's kind of a real challenge. So I think I see a big regulatory hurdle that we have to overcome in at least in continental Europe. And what we additionally see with batteries that most of you know it in the past, FCR was the place to be for batteries, but prices declined steadily over years. Then we had some good months, end of last year. Actually, that's not the revenue stability you want to have to plan a 6, 8, 10-year investment, right? So what we also sense, especially now with the high volatility, that people want to have an alternative revenue stream, right? To just balance out the risk of just betting everything on FCR. And I can just tell you with the technology that we developed, we're close, right? So we have combined use cases where FCR plus intraday increases the overall value. FCR is still the leading revenue stream, but wait another 6 months or a year, depending on where FCR goes. So I think also that is a good development, right? So basically what I said is the volatility introduced by renewables make the business case for storage that's needed for getting the energy transition done, right? You just cannot build one side and just build like crazy 90% renewables. You would just have to over-dimension the capacities like stupid. So in that sense, even as a private consumer, I don't like the expectations, but I would argue the market works, right? I mean, the energy transition does not come for free. And what's happening on the market is enabling other technologies that we need to get the energy transition going. So
maybe if I just one quick thing to add to Jürgen's point. I mean, there's 1.3 gigawatts of home batteries installed in Germany. That's an absolute waste of resource just sitting there doing self-consumption optimization. Like the regulatory change has to happen very rapidly, because otherwise the overall cost for the consumers paying for the transition will continue to rise.
Absolutely. Well, on the subject of storage, while we cover this topic, hydrogen is very important, very hot topic right now. How about using hydrogen for long-term storage? Kim, we'll direct that one to you, and then Boasia, if you could also give a few thoughts after Kim.
Yes, thank you. I mean, it's certain that we need seasonal long-term storage in order to compensate the fluctuation power generation and reach 100% renewable energy system. And as Jürgen said, there are many different types of storages, but for long-term storage, there are not many alternatives because in terms of capacity and performance, electrical storages are better for short-term storage. We have physical storages such as pump storage, but they are limited and come with a major environmental impact. So hydrogen is a very good option for long-term storage. But we must be aware that hydrogen is also not available to us in an unlimited quantity. And therefore, we must know that hydrogen should be used efficiently and sparingly. And hydrogen should primarily contribute to the decarbonization of sectors that cannot be electrified or only can decarbonate with hydrogen, like some applications in the industry and heavy good transport, for example. So we can use hydrogen for long-term storage, but we must respect or taken into account many criteria when we produce hydrogen. Important factors also when we import hydrogen from other countries is, for example, the water consumption when producing hydrogen or the high efficiency losses, social factors also, and also the availability of renewable energies. So if we want to use hydrogen, we really need more renewable energies so we can focus on renewable hydrogen and not need blue hydrogen, for example, to fill the gap.
Boasia, your thoughts?
Yes, I'm not a physicist, right? But I would point maybe to one additional perspective in terms of storage. There must be sort of energy efficiency in storing power, in transforming it in another type of energy, and there must be obviously also economical efficiency. What I learned about oxygen is that it can be stored, or it can store energy for approximately 2 weeks, which is a really long term, at least from my point of view. But in general, every type of storage every storage technology will help to offset, to compensate the volumes, additional volumes entering the grid and resulting from the renewables volatility. We don't have anybody from the TSO side here in the panel, right? But every technology which can help to maintain the stability in a grid, and I count storage technologies to this type of technologies should be welcomed by the market. And on the other side, as I'm representing more, the market perspective, every type of new technology which can be marketed in on both demand and supply side opens new possibilities for trading. So from every perspective, starting with this technical perspective, efficiency perspective, over to trading perspective, these type of technologies will be welcomed by the market. That's my point to it.
Mm-hmm. Excellent. Next question, I'll stick with you actually, Błażej, and also Jürgen. What role does data and technology play in trading on the spot markets? We touched earlier on the Australian trader who tried to trade the battery manual. So, yeah, what role does data and technology play in trading on the spot markets?
I would extend this perspective of the spot market by neighboring markets as well. So I see this still as a triangle of markets: spot, intraday, and balancing, because they depend on each other, right? And as we see, on the one hand side is increasing volatility in generation. On the other, we see all around also growing traded volumes. We see also the growing usage of APIs, as Katarina mentioned. We see more and more business for every type of algo traders, supported by machine learning. I would say data is becoming more and more crucial element of the system. So handling the data, not only by human beings, represented by old school analysts in the market, but also by modern analysts, the algorithms. Here I see the future for the market in general.
Excellent. Jürgen?
That's a good one for me, right? I mean, we do everything fully automated. So when it comes to data, of course, super valuable. I still have the feeling that not everything is available that could be available. I mean, try to get forecast data, historical ones, so that you exactly know at the 2nd of March 2021 at 3 p.m., 12 minutes, what was the latest forecast. This is what you need to train the models that I've presented before. So I think there is a lot of value in data still untapped because not available. I mean, that's what we did from day one, collecting data actually before we even started trading. And I fully agree with the complexity, especially when it comes to flexible assets, right? I mean, what manual trader wants to make sure that your 1.72 cycles of your lithium ion battery or your throughput in megawatt hours is within the limits, right? If you trade it manually, you trade all the products on SIDC, on local products, and in quarter hours. You have to have minimum spreads too. So I think there is no question if it's crucial or not. There is already use cases where you will really lose as a human trader. So that I wouldn't even try to start. So I would never ever trade a battery on intraday manually, right? It's just so far away from being optimal. We're not talking about scratching out the last 20% with algos. It's just so complex and it doesn't make any sense. So I think it's imperative for some use case to have that. And I would go even further. We're talking a lot about trading and algos. What Alex said before, this means also the dispatch of the asset has to be automated, right? It doesn't help you if you execute in milliseconds and have real-time optimization and you have to stop trading 1.5 hours before physical delivery because somebody has to walk to the asset and press the button, right? So I think that that's really the chain from data vendors, forecasts, whatever, down to the dispatch of the asset. This is the stuff we have to automate, and where data is the blood, right, in this process.
I just wanted to send one number, to throw one number in the air, just to make it a bit more intuitive. Which amount of data are we talking about? So the fleet of monitors, which I mentioned in my presentation, WoodMac fleet of monitors, and this is just one aspect, right, of the whole story. This real-time generation. This fleet produces 2 million data points every day. So this amount of data we talk about, right? And on top, we have to add all these other perspectives, which Alex and Jürgen mentioned, like dispatch and timing and just trading data, right? Order book data, both sides, and volumes, which Katharina mentioned. This is not controllable by a human being anymore.
Yeah, absolutely. Just before we go into the final question from my side, I would just ask all the audience to have a look at the question and answer section and upvote the questions which you would most like to see answered by the panel in the final 15 minutes. Final question from my side, though, I'd like to direct this one to Jürgen. Everything we've discussed, how does this all actually help in preventing blackouts?
Yeah, that's a good one, actually, for all the guys that thought like, okay, this was the clickbait title, right? to hook me in. So we're strong believers that what we do helps balancing the grid. So there is no objection that really in last instance the TSO prevent blackouts, right? These are the guys that sits in the dispatch centers, they throw off load, etc. But what has changed over the last 10 years, right? 10 years ago, everybody just relied on ancillary services. Everybody leaned back and said, okay, it's TSO's business. They procured like their FCR and whatever stuff, AFRR, and it was their business, right? And what happened, and if you look at the volumes that Katharina showed you, this gap is not there anymore, right? The market 6 years ago mainly ended the day before at lunchtime, right? And then was up to more than 30 hours until physical delivery, and nothing happened in that period, right? It was all TSO business. They had to anticipate, is the grid long or short, call power plants, whatever, right? And what we've seen in the data is that people start optimizing closer to physical delivery. Also, you've seen it in the data that Blasi showed us. So by doing that, or why do we do that, is because the spot market is the market where all these intraday fluctuations have to be balanced, right? It's partially depending on the market in the balancing agreement. It says you have to balance your renewables. So every forecast deviation has to be traded there, right? So you cannot sit there and just rely and say, okay, it's TSO's business. Even better, every market player with an asset can participate to help relieving all this stress from the TSO in a perfect world. And we know it's not perfect. If everything is balanced, every single balancing group is balanced before physical deliveries, the TSOs just lean back and the frequency will be at 50 hertz, right? That's the balancing group concept we implemented. If all single entities are balanced, the whole market is balanced, right? Same holds true in the other direction. So if just you put in your latest forecasts in the spot auction and then you lean back, all the burden will be left with the TSOs. And we had that cases in the past. Some of you might remember people saying they deliver gigawatts more wind, and suddenly the TSO is faced by a situation where they miss gigawatts of generation, right? So this intraday market or the spot markets, they can be a helper for the TSOs, or they can be a pain for them, right? If it's not managed. And everything you have heard today, if managed properly, will bring additional flexibility that allows to integrate more renewables. This will help TSOs do their job and reduce the risk of doing a blackout. So we're a firm believer that we help TSOs. Next time we also invite one of the TSOs to see if they have the same opinion.
Excellent, thank you. Okay, so we've now got a bunch of very interesting questions from the audience. I am going to start off with two questions, one from Toby Stanway and the other from Nick Speechley. Good to see you both here. Starting with Toby's question, renewable asset investment decisions will generally be made on long-term price forecasts with a capture rate assumption rather than short-term price expectations. How much do you think this kind of optimization can add to the value of an asset, and/or how much is this kind of optimization already taken into account in capture rate forecasts? Anyone in the panel want to answer that one? And Jürgen will be our go-to respondent if no one else volunteers.
In Austria, this game is called Black Peter, right? So the guy that's left at the end. Can I read it also somewhere, Ben?
Oh, please, yes, down in the Q&A, questions and answers.
Because it was a rather long one. Renewable asset investment decisions. I can share our point of view on that one. So what you typically have and why PPAs have been that famous in the last years, you just want to have a secure revenue stream, right? In an ideal case, you get pay as produced. You get a fixed price. You can choose if you keep the volume risk or not. There is several setups. So what's happening is, of course, the counterparty on the other side, they have to price this balancing risk, right? They will know if they just offtake all the volumes that you will produce, they will run a percentage of it in balancing energy. They have historic imbalance prices. What you can do, and now I split the scenario. One is just have a look at your basically hedging strategy until spot. And what you can gain when trading out wind deltas, for example, on intraday. The difference between trading it bad and good is euros per megawatt hour. So just so to get a feeling, now it depends on the size that you have, but usually you don't get rich with trading out intraday deltas, because if you know there is too much wind, it usually means there is too much wind in the whole market, which most likely means that prices go down. Not always, but there is a strong tendency for that. So you don't get rich by trading out wind deltas, but you avoid imbalances, and your TSO loves you because you comply with the contract that you have. But now imagine you can save €1, 2 or 3 euros per megawatt hour, and you can play that now between human traders that sit 24/7, do trades, or have a highly sophisticated trading platform with all the fancy stuff that I told you. And if you get 2-3 euros better per megawatt hour and you accumulate it over the year, that's quite a topic. If you're on the side of building the renewable assets, you never know what pricing magic is on the other side. I can only talk from a trading perspective. So people with a very good short-term optimization, they can take out some risk and maybe have a more competitive pricing, if we want to look at it from that angle.
Maybe one other aspect to, or kind of a different, one kind of parallel and overlapping kind of way of looking at it is, if we think that, you know, PPA off-takers, at least in our experience, charge somewhere and a spread somewhere between 2 to 10% for the balancing risk shaping premium. And so that's just, no, that's lost, right? And so fundamentally, in that case, there's little room for optimization. And so you kind of, if you need to take on that risk, and then, you know, if we look at, I mean, our forecast data is a little bit old because it was looking into winter 2020-21 at the beginning of winter. So, you know, pardon me if it doesn't look exactly like it probably ended up, but, you know, we saw that off-taker premium equating to somewhere between 2.5 to 12 pounds a megawatt hour. So that's, you know, that's a non-insubstantial amount of uplift, especially for the asset owner or the fund.
Excellent. Well, the next question, it's a follow-up to Toby's, and this is from Nick Speechly. To add to Toby's point above, can you also touch upon price cannibalization for capture rates as storage and flexibility more broadly is adopted and trading strategies become more sophisticated? Price cannibalization for capture rates. Who wants to cover that one? And that's the bottom question of the second from bottom question.
I can add some sentences on that. It's a very frequent question, I have to say. I mean, you'll see it. Let's take, for example, FCR in the German markets. The requirement is stable at 600 megawatts for years, so 600 megawatt-ish, and the prices go like, I mean, they went down, then they went up. Let's see if they get down again. So I think that whenever we increase the share of renewables, we introduce volatility, because that's just the nature of the business, right? That will increase volatility and the prices to a level where hopefully the storage pays off. If we start to overbuild storage, just the spreads are getting smaller, right? If you look at your ideal or the biggest spread of a day, it may be at the moment 150, 200, 400 euros. If you look in the dashboard today, there is not hundreds of megawatts available at that spread, right? So the fastest ones get the best spread, the ones with the best expectation of the market, and then the spread will narrow. So at some point in time, we'll reach a point where it's simply not feasible commercially to build another battery or another pump storage or another whatever, right? So I would assume that the market has this regulating effect based on commercial signals and price formation, where and it says what technology pays off and which one does not anymore, like it does now with the merit order, right, on the generation side.
Excellent. Another question, and Jürgen, this one is specifically directed to you, so it will be you again. It's another popular one. This is from Sebastian Haglund El Gaidi. Jürgen, what is your view on the more stochastic optimization versus RL? Stochastic optimization is potentially more interpretable since it can provide, e.g., risk metrics versus RL, which is more a black box.
Yeah, that's a tricky one, unfortunately, right? So I give you a view on that. So one big work package in our deep tech grant that we received is explainability or interpretability of models, right? So, I mean, you may want to use a Monte Carlo simulation or whatever model, right? To come to a goal, which will be fine. But if you think about leveraging, I mean, Blažej said it, millions of data points per day. I mean, of course, you can aggregate, but then you want to cluster it to market phases or whatever. Our experience that just the overall process gets so slow and complicated that you have to leverage newer technologies or even lose data quality, right? Because you have to aggregate it to reduce the amount of data. At the moment, we have different technologies, even for same use cases, right? You could optimize a parameter brute force with historical data. You could optimize it with a random forest. You can optimize it with a genetic algorithm. You could use a reinforcement learning setup, a neural network. So our goal is always to have a model that we can understand and that's as easy as possible, right? If an easy model does the job, why should I use a reinforcement learning model? There is other tasks like getting into the self-learning mode, and with self-learning, we have regular backtests, right, that check real-time trading performance, adapt parameters, and all that stuff. But really, in a reinforcement learning setup, there is no other stochastic model that could do that. My view is we don't use it just to use it. We just use it for use cases or for comparison. So we also do stuff that we did with another machine learning technology, for example, to see if another technology, neural networks, reinforcement learning, improves the results or not, right? Just to validate if the technology is appropriate for the use case. unfortunately, there is no literature or something where you could read this use case in the energy industry and use this technology. I hope I answered the question. Ish.
Good. We've got one more question I'll take from the audience before I hand over for some closing comments. This is from Andy Field. Question to anyone. With more and more automated trading, do asset owners continue to outsource the problem to aggregators and optimizers, or do they build the skill set to handle in-house? Anyone want to give that one a try?
I'll take a first pass at that. So I think we need to maybe kind of disaggregate what that actually encompasses, because if we think of, like, for example, and we've talked about batteries a lot, but I feel like they're very versatile use case and example. If we go back 5 years, or 5 to 10 years ago, anyone who was leaning forward and investing in a battery was automatically going to an aggregator and an optimizer and a route to market, because it was the unknown, and someone else had to kind of provide some capability. What we actually see now happening is, depending on the service, some larger asset owners are taking elements of this route to market in-house, because they're realizing that placing an FCR bid is really not complicated, and they're just paying a 5% revenue premium to someone else to shuffle some paper and add a few clicks. But then as we look at kind of full stack, and as markets reform and we're able and assets are able to perform revenue stacking and multiple actions in multiple markets simultaneously, that's a capability that I don't think many asset owners want to invest that deep tech investment for a very different business.
Try. In that case, that brings us in a very timely manner to Jürgen for the closing comments and to wrap up.
Yeah, thanks again to everybody, people who are listening and took the time, to the speakers, Alex, for having a great view of one of the most innovative utilities, if I can call you like that, with Octopus, a well-known global player. Katarina, as always, thanks a lot. It's always interesting to see the exchange point of view, to really get a feeling what's going on, and some million orders per day is quite impressive, combined with thanks, Blaži, for your data points and the interpretation. And what you're working on, and Kim and Mats, I love your project with this focus on having, rather helping the avoid curtailments in the local region, and I think that's the future. Also moving from a very centralized, holistic market to also look at local problems in the future, and I think that's just a very good step. So we have seen a lot of different aspects on the topic of flexibility. We presented how to trade it, and I'm sure it's our obligation to help make the grid more flexible, right? And I think we managed to share some insights and get rid of the last excuses to not offer your power plant or your flexibility on the spot market, right? Then marketing is not over a day ahead at lunchtime. You can continue the optimization after your lunch, right? It's totally fine. Or work with other players. So thanks a lot to everybody.